All right, let's just dive right into this. I want you to step into my shoes for a second, the shoes of a registered financial advisor. Today, we're unpacking a really massive shift in the landscape of personal finance, looking specifically at OpenAI's new finance-focused ChatGPT window. In this explainer, we're going to break down the actual capabilities, the hidden risks, and, honestly, the existential industry question facing advisors exactly like myself right now.
Because it really boils down to this multi-million-dollar question, doesn't it? Would you genuinely let an artificial intelligence manage your money? Like, are you actually ready to hand over your life savings, your retirement plans, and your family's future to a line of code? Now, I know it sounds a little apocalyptic, but trust me, this reality is arriving way, way faster than most people realize.
So let's get into Section 1, the rise of AI advisors.
Look, this shift toward AI and personal finance, it isn't some distant sci-fi future state. It's literally happening right now. OpenAI is currently piloting a dedicated finance tool that goes way, way beyond a basic chatbot. And you've got platforms like Robinhood announcing they'll soon let users trade entirely through AI agents. The AI revolution has firmly planted its flag on Wall Street. This new ChatGPT capability, it actually lets you link your real bank and investment accounts. It pulls your personal data, analyzes your expenses category by category, and reviews your whole investment portfolio. Amazingly, it supports over 12,000 financial institutions. It even stores what they're calling financial memories, basically saving details about your specific goals from past conversations so it can give you tailored advice later. It's a seriously comprehensive tool.
But, access doesn't come cheap just yet. Right now, this pilot program is limited to US Pro users, meaning it sits behind a hefty $200 a month paywall. Let me put my advisor hat back on for a second. If you've got a $100,000 portfolio, that $2,400 annual cost, that represents a 2.4% annual fee, which honestly is incredibly expensive compared to traditional wealth management fees. But as a highly specialized tool, we have to admit it offers some undeniable advantages.
Moving on to Section 2, the unmatched accessibility of AI.
Even as a professional advisor, I absolutely have to concede that AI brings some massive pros to the table, especially for folks who have historically been totally left out of the wealth management ecosystem. The harsh reality of the finance industry is that high-quality planning is usually reserved for the wealthy. Minimum account balances literally price everyday people out of the room. AI completely democratizes this. It offers 24/7 on-demand reviews of your financial situation. But beyond just accessibility, there's a massive psychological advantage here, and that's anonymity. Finance is a highly sensitive, vulnerable topic, right? People feel shame or guilt or embarrassment about their spending habits or their debt. Well, with an AI, there's absolutely no fear of judgment. You are so much more likely to be totally honest with a machine than you are sitting across a mahogany desk from a human in a suit.
Think of it kind of like the Googling symptoms of finance. Just like running your medical symptoms through a search engine at 2 a.m., knowing there's zero judgment on the other side of that screen, AI provides a fantastic, quick baseline for your finances. It's a really great starting point if you're a DIY investor.
But let's look at Section 3, when AI makes things up.
Here is where we desperately need a reality check. As advanced as AI is, it's still prone to hallucinations. Sometimes it just completely makes things up. Take this real, totally absurd example from the source material where an AI insisted, "There are no E's in the word 17." It even spelled the word out to prove its incorrect point. I mean, if an algorithm can fail a 5th grade spelling test, do you really want it dictating how you invest your family's life savings? OpenAI notes a benchmark score of 82.5 out of 100 for this model's financial tasks. Okay, that's a solid B-, sure. But what exactly happens in that other 17.5%? A rounding error is one thing. Advising someone to YOLO their life savings into a meme coin is a whole different ballgame.
So the absolutely crucial point here is that AI output is entirely dependent on the exact structure of your prompt. Asking the AI for the top 5 stocks to buy today to hold for 10 years versus asking for stocks to buy for today's date actually changes the recommended investment list. It'll literally swap out heavy hitters like Alphabet and Amazon. If you aren't familiar with how to structure your prompts perfectly, a slightly poorly worded question could land you an entirely different and potentially subpar investment strategy.
Plus, AI really struggles with missing context. When I sit down with a client, the most important information rarely comes from a spreadsheet, It comes organically through conversation. We talk about their marital status, their kids, dependents, their general health, and timeline. Unless you proactively know to prompt an AI with every single one of those messy life details, the machine is going to miss the crucial context required to build a truly comprehensive financial plan.
Which brings us to Section 4, the fiduciary duty problem.
This highlights a glaring legal and regulatory divide between Silicon Valley tech companies and actual registered financial institutions. In the financial world, fiduciary duty is a cornerstone concept. It is the strict legal obligation to act solely in the best interest of the client, putting their needs completely above your own. OpenAI? They don't have this. They're not a registered financial advisor. Slapping a not financial advice disclaimer on their platform doesn't magically erase the fact that people are paying a fee and receiving tailored financial direction. Right now, it is entirely a use at your own risk Wild West.
The difference in accountability between a human and a machine is just staggering. Human advisors are bound by know your client rules. We literally have to demonstrate that we've done the research to understand the specific securities we put you in. We face heavy legal liability for our advice and strict regulations on how we handle conflicts of interest. AI platforms currently operate in this massive gray area, completely lacking that legal duty of care.
And honestly, those conflicts of interest are already materializing. ChatGPT recently announced a paid integration partnership with Intuit, the tax planning software. Now, Intuit has great tools, sure, but it means they're effectively paying ChatGPT to integrate their products into this finance offering. Because OpenAI has massive amounts of your user data, we have to be super cautious about this sort of lucrative advertising. It could quietly redirect users to financial products that benefit the platform's bottom line, rather than products that actually make sense for the user's personal situation.
All right, Section 5. Why human guidance remains.
Let's wrap this all up. Despite the incredibly impressive technology we've looked at in this explainer, as a professional, I can confidently tell you that AI is not about to make human financial planners obsolete. And the most fundamental thing you need to take away from this is this: a large language model is not a judgment model. Systems like ChatGPT are not sitting down, poring over obscure financial data, and coming up with a deep, proprietary investment thesis. No way. They are simply stringing together plausible words based on the data they were trained on. They are predicting language, guys. They are not exercising financial judgment.
You might see these flashy headlines about AI platforms claiming to beat the S&P 500, but when you actually look under the hood, those outsized returns almost always come from unsophisticated, high-risk gambles. It's basically YOLOing into individual stocks, where a few lucky outliers pull the average way up. That is gambling. That's not planning. A human advisor strategy focuses on holistic, context-driven life planning that builds a rock-solid, customized financial foundation. And the data totally backs this up. Polling from Vanguard shows that the #1 reason people seek out financial advisors isn't actually to get the best possible stock pick, it's for peace of mind. People hire advisors for the fundamental human desire for safety, reassurance, and trust.
Ultimately, it comes down to this simple truth. Finance is deeply, deeply emotional. AI is not. The famous Dunbar studies have shown for years that it isn't poor stock picking that ruins individual investors. It's emotional panic. It's selling at the absolute bottom of a market crash because you're terrified. An AI algorithm cannot offer the vital emotion management, the reassurance, and the steady hand that a human professional provides when things get rocky.
So, I'm going to leave you with this final thought to ponder. AI is an incredible tool for data synthesis, and yes, it's a fantastic starting point for the DIY investor. But when the market crashes and your life savings are genuinely on the line, who do you actually want on the other end of the phone? A language prediction model or a real human being who understands your life, your family, and your fears? Thanks so much for joining me on this explainer. I'll catch you next time.